Okay, what we're going to talk about today, and I know she mentioned business income losses, we're going to talk about contingent business income losses. And so what we're going to do is we're going to talk about the general, it's not working. Just get a little, okay, there we go. Okay, thank you. So as I was saying, we're going to talk about contingent business interruption insurance and how we go about when we're brought in to measure the loss of business income on a contingent business income incident. Okay, so just kind of go through what we're going to talk about. We're going to talk about what is contingent business interruption coverage for some of those that may not know. What are some of the coverage triggers, which in terms of the causes of loss. We're going to go through defining the scope of damages, talk about an individual company's supply chain and how if that gets disrupted, they may have a covered claim from contingent business interruption. And we're going to go down through some of the ways that the businesses may mitigate their loss because they have a duty to mitigate. And then Christian's going to talk about CBI from a German perspective. Okay, there's the supply chain. And as the world economy has become more global, what you've seen is an individual businesses, their supply chain has become more global. So when you look at the supply chain, it starts with the sourcing of, from a manufacturing perspective, the sourcing of raw materials, going through the supplier, then going through the manufacturing process, then it gets distributed out to the end user or the customer. So now that you've got the supply chain that's become global, there are a number of areas around the world that, if impacted, could create large contingent business interruption claims throughout the world. Okay.
So we might know some of these pictures. Not hard to guess, this Japanese earthquake had a big impact also on Central and Eastern Europe. We have the Thailand flooding, the public unrest in North Africa, also interrupting supply chains, or a simple fire destroying a supplier, for example, Central Eastern Europe. This all has an impact on business and business interruption with today's supply chain being integrated globally, fine-tuned, so wherever anything happens, it interrupts the supply chain. And Derek is going to come to this. I think we have to think of companies in a new way. In the past, a company was a legal entity, like a factory standing there. Today, there's virtual companies. So they interact. You have a supply chain with a lot of companies. So it's more of an organism, economic organism, which is not the same anymore as the legal entity. Whatever affects this organism affects also your business supply chain.
Okay. Go to the next slide. So what is contingent business interruption coverage? Contingent business interruption insurance, or is also known as CBI, and contingent extra expense coverage is an extension of first-party property insurance that reimburses a businesses for lost profits and extra expenses resulting from an interruption of business at the premises of a customer or a supplier. The contingent property may be specifically named, or the coverage may blanket all customers and suppliers. It's also known as contingent business income. You may have heard it as contingent time element insurance or dependent properties insurance. Okay, so some of the elements of CBI coverage is there's physical damage to property, but it's physical damage not to the insurer's property, but the property of a dependent property. So in order to, we're going to get to some of the coverage triggers on the next slide. The peril causing the CBI loss must be covered on the policy of the insured, and it really results in an inability for the insured to supply, deliver, or accept goods and/or services. So it'd be a situation where a policyholder or insured has no physical damage to their property, but one of their customers, primary customers, or one of their suppliers have been impacted, and as a result, it results in a loss of business to them personally. And as it says last there, it results in a financial loss to the insured's business. Okay? So, important things to consider when evaluating, or really the first step in the loss evaluation process, when a claims adjuster gets to, gets involved in a CBI claim, is you really need to review the policy because you've got to look at the local policy. There's issues with the global policy. You've got limits. sublimits, deductibles, coinsurance, and exclusions. There was a survey that Ernst & Young put out several years ago, which was a survey of risk managers, and what they found was 54% of businesses had a defined CBI sublimit, 36% had a duration sublimit, 31% had various specific exclusions, and 33% had identified locations. So, one of the issues is, you got to look at the local and the global policy. And a lot of times what I've seen is there are some territorial limitations where you've got a business in the United States that has filed a CBI loss and they don't have global coverage, yet the supplier is outside the continental U.S.
So you're covered by a safety net, but it has some big holes in it.
Yeah.
We come to this later on.
Right. And then contingent extra expense coverage, which I mentioned a few slides ago, reimburses a policyholder for extra expenses incurred resulting from a contingent loss. It basically follows the same rules as CBI coverage, and it could be one of the basic forms you'd see where you've got pure extra expense, or it only covers the policyholder for the extra expenses to reduce the loss. For example, an insured can't spend $400,000 to save $200,000. Okay, in terms of the coverage triggers, and this kind of goes back to what we talked about a minute ago, the physical damage to property is required to trigger the coverage, and it's physical damage to a dependent property. And I'll go through some of the definitions of what of dependent property on a future slide. The physical damage must be caused by an insured peril on the policyholder's policy. The damaged property must be a dependent property, and the damage at the dependent property must be the cause of interruption. Some of the issues that we've seen, common issues, especially in large catastrophe situations, are we've seen where you've had suppliers that are in an affected area, and they've been unable to supply product to an insured, who has then filed a CBI claim. But some of the issues that we found is that there was no direct physical damage to the supplier. You had issues where there was problems there was damage to the port, so they couldn't get their product, they couldn't distribute their product to this particular insured, whereas there was no direct physical damage to their facility. Okay. Kind of go through some of the dependent properties. You've got contributing locations, which are the suppliers. And most of the policies will exclude not a contributing location are water supply services, power supply services, and communication supply services. You've got recipient locations, those are the buyers. You've got manufacturing locations, which could be a third-party manufacturing location, like a co-packer, where you've got an insured that utilizes a third-party manufacturing facility to produce a portion of their product. And then you've got leader locations. That could be, a good example I've seen is you've got a shopping center, and you may have a retail operation that's located outside of the shopping center. That shopping center could be defined as a leader location. It's basically something that draws customers to an area.
And the problem being you actually have to choose. Being a company, what you want to have insured, it's either suppliers, it's customers, there's also infrastructure risk. So you have to choose what risk to cover against which perils and to which level, direct, indirect, first layer, second layer, third layer. So it's your choice. And if you make a mistake in this, you might have a big problem.
Okay. So from a claims perspective, defining the scope of damage. For the claims adjuster, and we're the accountants, we're the forensic accountants that come in and we'll quantify, measure the loss from an economic perspective. So we don't opine on coverage, so we rely on the insurers and the claims adjusters to determine the coverage. But from a claims perspective, one of the difficulties with the CBI claim unlike a first-party direct loss, is it becomes a challenge confirming the scope of the physical damage. Because a lot of times the claims adjuster doesn't have access to go on site and look at physical damage to a supplier that's not the named insured on the policy. So in defining the scope of damage, it's important to confirm the scope, confirm the type of property covered, confirm the covered cause of loss, any exclusions, and then to verify supplier customer status. We talked about earlier, there may be different limits, deductibles, waiting periods, and so forth. So what is the supply chain for a specific individual business? So you've got you've got upstream and downstream. You've got direct suppliers, and a direct supplier is a supplier that directly supplies component parts or raw materials to the insured, whereas a second-tier supplier would supply raw materials and component parts to another supplier that then would be the direct supplier of the insured. And that can become an issue if the insured's policy only includes direct suppliers, or it has named suppliers, and then the indirect supplier is not named.
And coming back to NatCat, natural catastrophe topic of today, Thailand flood. So if you have only covered your first tire supplier, but the whole area is flooded, it might not have worked anyway. So you would have had to cover at least 2 or 3 other layers.
And then you have downstream, which are the customers. And some of the issues from a measurement standpoint, when we're evaluating whether there's an actual business income loss to the insured is, can the customers wait? Can they just delay the shipments? For example, you've got a insured who can't get raw materials. Do they have inventory, safety stock that they're able to mitigate their loss? We'll talk about mitigation and so forth. So there's always some issues that we'll run into when measuring the economic aspect of the business income loss. So in terms of mitigation, as I mentioned, the insured has the duty to mitigate the loss to the extent that they can. So different ways that they can mitigate the loss if, for example, they've got safety stock, and safety stock would just be excess inventory that's on hand that in order to meet sales orders, they could just pull from inventory. And then they may incur some additional costs later to rebuild that inventory, which could fall as an extra expense, which was one of the topics we covered earlier. There could be where, just because they can't get parts and supplies, it may not result in a direct loss of sales and subsequent loss of profits. It could be that they just, the sales actually delayed as opposed to being actually lost. And then there's some product substitution. You see time and time again where they'll alternatively source some raw materials from another supplier, and they may incur additional costs to do so. They incur additional costs to have that supplier be approved, and they may have to have a production line retooled, and to do that they may incur some additional costs, but ultimately not result in a loss of sale. So they may incur some additional costs, but mitigate and minimize the business interruption loss by doing so. And then documents to request from a claims perspective is contracts with key suppliers, contracts with key customers, force majeure letters, and then information from suppliers, if available. And as I mentioned, a lot of times they don't have the opportunity to go on site and actually observe the physical damage. So Christian's going to talk about CBI from a German perspective.
Yep. So we may ask ourselves, why is this relevant to us sitting here? Just take one step back. As we mentioned at the beginning, I think we have to regard the industry as a sort of integrated network nowadays. So there's outsourcing, just-in-time deliveries, low stocks, production optimizations. So it's all integrated, and one very good example of this is Germany, sitting in the center of Europe. And I'm having my office in Frankfurt and worked in the chemical industry for 20 years until my biggest factory burned down. So now for 10 years I'm forensic accounting. So what does this mean? If we take large area damage, for example, a flood in Thailand, as you may have been aware, about 2/3 of major electronic components worldwide are being manufactured there, going into the automotive industry, very strong in Germany. You had Japan, a lot of German companies producing there, chemical companies, pigments, etc., being used in the German industry. We even had some riot cases in North Africa for textile industry, which led to interruption of supply chain, or a classical loss here. I'll take this one.
Sure.
If you take the German example, how does Germany incorporated work? And I'm also taking a bit of a Central Eastern Europe perspective here. I already have about 1/3 of my claims in Central Eastern Europe. Why? Because it's closely integrated now with Germany. A lot of component suppliers are there, raw material suppliers, especially in the automotive sector. So how does it work? So in Germany, we have mostly an integrated supply chains, many companies working together. Let's take automotive again. We have just in time, minimize stocks, no stocks to mitigate. A lot of things are outsourced. The automotive industry in Germany has outsourced 75% of its value creation. So a big automotive supplier like Daimler, VW, BMW is just making 25% themselves, the rest is outsourced. We have optimized capacity, so there's no spare capacity. There's a lot of export-oriented small, medium enterprise supplying these big automotive suppliers or chemical suppliers, hidden champions, and it's all, let's say, I call it the perfect machine. If everything goes right, it's perfect. You have no stocks, you have no cash, it just goes in, just in time, goes out, but you're heavily relying both on your suppliers and your customers. And you might notice this from modern times, Charlie Chaplin. So if everything goes right, you can make a lot of money. But if anything goes wrong, if a machine gets disrupted at any point, you have a big problem. So how does it work? The German companies use a sort of workbench approach for components, for labor-intensive items and raw materials. This gets in, for example, a lot of raw materials, for example, from Australia, from other countries, down to iron ore. Labor-intensive items used to be outsourced to China. A lot of things are coming back to Eastern Europe now because it's even faster, sometimes even cheaper. And every labor-intensive item is being outsourced. And on the other side, a lot of export of complex technology-intensive products. What happens if there is a disruption in the supply chain? And contingent BI, we can also call it supply chain interruption. So if anything goes wrong, either your supplier is damaged or your customer. A typical German contingent BI coverage, FBOB, that's the local conditions here. You usually have just one direct nominated supplier, so you can choose in your coverage. If you have just one, if you have nominated suppliers in, or all of them, usually you have only one. Then you have the same risk covered as in your classical policy, which is usually fire, explosion, etc., not necessarily earthquake, radiation, whatever, large-scale flooding. So you have a mismatch between your property policy and what will actually happen, especially in large area damages. You usually have low sublimits, so you do have a CBI coverage, but just nominally with, let's say, 1 million inside or maximum 5 million, which does not really help you if you have a large loss. And you usually don't have penalties included as a special coverage, especially important for the automotive industry. As you know, if a standstill is happening at the automotive plant, it might be 50,000, 100,000 per hour. So what happens then? I'm going to go through some practical examples for this and why I would see this as an existential risk, especially for small and medium-sized suppliers, be it in Germany or in Central Eastern Europe. One case I just was last week, a factory in Poland burned down, which supplied a chemical which went to an automotive supplier. The chemical value per year was 30,000 euro, just small. And the sales value behind at this company was 22 million. They're completely depending on this one supplier. Other examples, when the Thailand flood happened, car hi-fi producer, radios for the car, could not ship it because one chip was missing. And because of this, a big automotive supplier in Germany had a standstill. So one minor component missing, it interrupted the whole supply chain. One more example here. Can you avoid this by good risk management alone? I also worked in the chemical industry, and we always say, yeah, if anything happens, we have it covered. We have second sources, third source, fourth source. This actually does not really work. This is a practical example, some 2 or 3 years ago. You have a big automotive supplier. He gets his plastic parts, for example, for door handles, etc., from 4 different suppliers. They are all audited. They are all working independently. So whatever you have, you can get it from 4 different suppliers. What they did not have in mind, that they got their plastic itself, all 4 of them, from one big supplier, all again in Eastern Europe. So when this one burned down, all 4 were interrupted, and the automotive supplier as well. And the second supplier was just minor. He couldn't handle this. So what the topic today is, we have on the one side, we have the risks which are materializing, for example, flood, earthquakes, and other things. And the question is, how does the industry react to this, and what kind of coverage can be given from the insurance industry? I would give, again, a focus on the connection between Central Eastern Europe and Germany. It's heavily interconnected, even down to Turkey. It's part of a supply chain network. There are frequent losses. And if this risk, as I say here, a classical Thailand flood risk would not have been covered here because we don't have flooding inside, no earthquake Japan. Another example from Thailand, the supply chain was interrupted until the 3rd layer. If you have just covered the 1st layer, you actually get no compensation, which is why I mentioned at the beginning, the net is there, the concept is there, but it has big holes in it. And it can lead to existential risks, especially for medium-sized companies in the supply chain. I would say that we discuss this a bit more in the panel later on, and I hope for a fruitful discussion.